In 1971, the President of the United States went on television on a Sunday night and quietly ended a promise that had defined the entire global economy for over 2 decades. He didn't call it what it was. He called it temporary. That promise has never been kept since. And right now, in 2026, gold, the very asset that promise was built on, just did something it has never done before. It has posted dozens of new all-time highs. Central banks are buying it at a pace not seen in half a century. And some of the biggest banks on Wall Street are now saying it could double again before this decade is over. So here's the question we need to answer today. Is gold just another shiny trade? Or is it the last honest asset left standing in a financial system that keeps breaking its own promises? Stick with me. By the end of this video, you'll understand exactly why gold keeps coming back, and why so many smart investors believe the window to prepare is closing. If you've turned on the news in the last year, you've probably heard the same words over and over. Inflation, national debt, interest rates, recession risk. It's noise. It's overwhelming. And most people just tune it out. But underneath all that noise, something quiet and massive has been happening. Central banks, the very institutions that control money for entire countries, have spent the last several years buying gold at a rate the modern world has never seen. Not stocks, not bonds, gold. That's not a coincidence. That's a signal. In this video, we're going to walk through the real history of gold as money, why it keeps returning every single time paper currencies get into trouble, what's happening right now with the US dollar and the Federal Reserve, and what the smartest institutions in the world are quietly doing with their own money. This isn't hype. This is a documentary-style breakdown of facts, history, and the analysis behind them, so you can draw your own conclusions. Let's start at the beginning. Gold has been used as money for roughly 5,000 years. Not 5 decades, 5,000 years. Ancient Egyptians used it. The Romans built an empire on it. Every major civilization that has ever existed eventually landed on the same conclusion. Gold works as money because of what it is, not because of what a government says it is. Think about what makes something good money. It has to be durable. It can't rot or rust. It has to be divisible. You can break it into smaller pieces. It has to be scarce. You can't just create more of it out of thin air. And it has to be recognized and trusted everywhere. Paper currency checks some of those boxes. Gold checks all of them. Here's the part most people forget. For most of modern history, the US dollar itself was gold, literally. Under a system called the gold standard, every dollar in circulation was backed by a fixed amount of gold sitting in a vault. You could, in theory, walk into a bank and trade paper dollars for real gold. That system gave people confidence. It meant the government couldn't just print unlimited money because every dollar had to be backed by something real. But that system didn't last, and the story of how it broke tells you almost everything you need to know about why gold matters today. Fast forward to August 15th, 1971. President Richard Nixon announced what's now called the Nixon Shock. The United States would no longer allow other countries to trade their dollars for gold. The link between the dollar and gold, the backbone of the entire global financial system since World War II, was severed permanently. Nixon told the American public it was a temporary measure to stabilize the economy. It was never reversed. From that day forward, the US dollar became what's called a fiat currency, meaning it has value simply because the government says it does, and because people agree to trust it. There's no gold sitting in a vault backing it up anymore. There's no physical limit on how much of it can be created. And once that limit disappeared, something predictable happened. The amount of money in circulation could grow far faster than the actual goods and services in the economy. When that happens over time, each dollar buys a little less than it used to. Economists call this inflation. Most people just call it everything getting more expensive. Now here's where it gets interesting. In the years immediately following the Nixon shock, gold, freed from its fixed price, didn't just hold steady. It exploded. Through the 1970s, as inflation surged into the double digits and confidence in the dollar wavered, gold prices climbed dramatically, eventually surging over 20-fold from where they'd been fixed for decades. That wasn't a coincidence. That was investors and everyday people doing the same thing humans have done for 5,000 years, running toward the one asset that no government could simply print more of. But that raises an obvious question. If gold reacted that way in the 1970s, what happens every time confidence in paper money gets shaken again? Let's look at the pattern. Here's something you'll notice once you start looking at financial history through this lens. Gold doesn't move randomly. It tends to surge during specific kinds of moments when trust in the broader financial system gets shaken. Take the 2008 global financial crisis. Major banks that had existed for over a century collapsed almost overnight. Lehman Brothers, one of the largest investment banks in the world, filed for the biggest bankruptcy in U.S. history. Governments around the world scrambled to bail out their banking systems, and central banks, including the Federal Reserve, began creating enormous amounts of new money to try to stabilize the economy, a policy known as quantitative easing. What did gold do during that period? It climbed for years afterward, eventually nearly tripling from its pre-crisis levels by 2011, as investors sought protection from a financial system that suddenly looked far less stable than anyone had assumed. Then look at 2020. The COVID-19 pandemic triggered the fastest economic shutdown in modern history. Governments and central banks responded with the largest coordinated monetary stimulus the world had ever seen. Trillions of dollars created and injected into economies in a matter of months. Gold responded by hitting a new all-time high that same year. Now, fast forward to today. As of mid-2026, gold has been trading above $4,000 per ounce, a level that would have sounded almost unbelievable just a few years earlier. In 2025 alone, gold set over 50 new all-time highs, and the total value of gold held worldwide surpassed 5,000 tons for the first time in recorded history, according to the World Gold Council. The metal's annual average price jumped roughly 44% that year alone. 3 very different crises, 3 very different decades. One consistent pattern. When trust in paper money in the broader financial system gets shaken, capital moves toward gold. So the real question isn't why did gold go up before? It's what's happening right now that would make this time any different. Let's talk about the debt problem nobody wants to say out loud. Here's a number that's almost too big to picture. The United States national debt now sits well above $36 trillion. To put that in perspective, that's more than the entire annual economic output of the US, China, and Japan combined. That debt doesn't just sit there quietly. The US government has to pay interest on it every single year. And as interest rates have risen over the past few years, the cost of simply servicing that debt has become one of the largest line items in the entire federal budget, competing with defense spending and major entitlement programs. This creates a genuinely difficult position for policymakers. Raise interest rates too aggressively to fight inflation, and the interest payments on the national debt balloon even further. Keep rates too low for too long, and inflation risks staying elevated. There isn't an easy way out. And that tension is a big part of why so many analysts are watching the situation closely. This is where the Federal Reserve comes in, the institution that controls U.S. monetary policy, sets interest rates, and has the power to expand or shrink the money supply. Every decision the Fed makes ripples through the entire economy, and every dollar it creates has an effect on the value of the dollars already in your pocket. To be clear, this is analysis, not a guaranteed prediction. Nobody can say with certainty exactly how the debt situation will resolve or when. But the historical pattern is consistent. When governments face large debt burdens, the path of least political resistance is often to let currencies gradually lose value over time, rather than make painful spending cuts or tax increases. Economists sometimes call this inflating away the debt. Oh, and if that pattern holds again, there's one asset that has protected people from that exact outcome for thousands of years. Which brings us to what the world's central banks have been doing. And it might be the most important clue in this entire story. Here's something most everyday investors don't realize. Central banks around the world, the very institutions that control currencies, have been buying massive amounts of gold for their own reserves in recent years, at levels not seen in decades. Think about that for a second. These are the same institutions that create paper currency, and yet they've been stockpiling gold at a historic pace. Countries like China, India, Poland, and Turkey have been among the largest buyers, adding gold to their national reserves year after year. Why would the people who literally control the printing press want to hold an asset they can't print? The most likely explanation, according to many economists and market analysts, is diversification and trust. Central banks are hedging against exactly the kind of currency and geopolitical risk we've been talking about, reducing their reliance on any single currency, including the US dollar, and rebuilding reserves in an asset that has held value across every currency collapse, war, and financial crisis in recorded history. When the institutions that understand the financial system best start quietly preparing, it's worth paying attention to what they're preparing for. This buying trend is a major reason several major Wall Street firms have released bullish forecasts for gold heading into the rest of this decade, with some projecting prices well above where we sit today. It's important to say clearly, these are forecasts, not guarantees. Wall Street predictions have been wrong before, and gold, like any asset, can also experience sharp pullbacks and periods of stagnation. But the underlying trend of central bank accumulation is a documented fact, not speculation. So if the biggest financial institutions in the world are moving this way, what does that mean for everyday people? Let's talk about what gold actually does, and doesn't do, for a regular investor's portfolio. Let's be honest about something most finance content won't tell you. Gold is not a magic investment that only goes up. It doesn't pay dividends. It doesn't generate income the way a business or a bond does. Over long stretches of history, stocks have actually outperformed gold on average. From 1971 through 2024, U.S. stocks returned an average of roughly 10.7% per year, compared to gold's roughly 7.9%. So why do serious investors still hold it? Because gold isn't meant to be your growth engine. It's meant to be your insurance policy. Its real value shows up during the moments other assets struggle, during inflation spikes, currency devaluations, banking crises, and geopolitical shocks. It's what financial professionals call a store of value, an asset that tends to hold or increase its purchasing power specifically when trust in the traditional financial system is breaking down. This is why many financial advisors suggest gold not as your entire strategy, but as a portion of a diversified portfolio, often cited in the range of 5% to 10% for investors seeking a hedge against inflation and market instability. That's not a universal rule, and the right amount depends entirely on your own financial situation, risk tolerance, and goals. This video isn't personalized financial advice. It's context to help you ask better questions when you talk to a financial professional. It's also worth mentioning gold's quieter sibling, silver. Silver tends to track gold's safe haven movements while also being used heavily in industrial applications like electronics and solar panels, which gives it a different risk and demand profile. Some investors use both metals together as a way to balance industrial demand exposure with pure monetary hedging. Now, before we wrap up, let's address the obvious pushback, because a good documentary doesn't just tell you one side of the story. It wouldn't be honest to present gold as a risk-free, guaranteed winner, because it isn't. There are real arguments against over-relying on gold, and you deserve to hear them. First, gold produces no cash flow. A share of a profitable company can grow its earnings and pay you dividends year after year. A bond pays you interest. Gold just sits there. Its value depends entirely on someone else being willing to pay more for it later. Second, gold can go through long periods of underperformance. After its peak in the early 1980s, gold spent nearly 2 decades trading well below that level, even as inflation continued to erode the dollar in the background. Patience and timing matter enormously. Third, past performance is never a guarantee of future results. Just because gold has responded a certain way to past crises doesn't guarantee it will respond identically the next time. Markets evolve, and so do the tools central banks and governments use to manage them. And finally, some economists argue that modern monetary systems, despite their flaws, have delivered decades of economic growth and rising living standards that a rigid gold standard might have constrained. The debate over sound money versus flexible monetary policy is a genuine ongoing disagreement among serious economists, not a settled question with one obvious right answer. The honest takeaway here isn't gold is the only answer. It's that gold has earned its place as one legitimate tool among several, and understanding why it behaves the way it does helps you make a more informed decision, whatever that decision ends up being. Gold has functioned as money for roughly 5,000 years because of the qualities that no government can print away: scarcity, durability, and universal trust. In 1971, the US severed the dollar's direct link to gold, and every major financial shock since then, the 1970s inflation crisis, the 2008 financial collapse, the 2020 pandemic response, and now the current environment of historic national debt, has pushed gold to new highs as people looked for something solid to hold on to. Right now in 2026, we're watching that same pattern play out again. Central banks are buying at record levels. Gold has posted dozens of new all-time highs, and the national debt conversation isn't going away anytime soon. None of this guarantees what happens next. Forecasts from major banks projecting gold prices moving significantly higher over the next few years are exactly that: forecasts, built on current trends, not certainties. Markets can surprise everyone in both directions. But here's the one takeaway worth remembering. Throughout all of recorded history, whenever human trust in paper promises has broken down, gold has been there waiting. Not because it's magic, but because it's real. It can't be printed, inflated, or promised away. Whether or not gold belongs in your own financial plan is a decision worth making deliberately, with real research, and, ideally, a conversation with a financial professional who understands your specific situation, not because of fear, but because you understand exactly why this asset keeps showing up at every major turning point in financial history. If this video helped connect the dots on something you've been hearing about in the news, but never fully understood, do me a favor and hit that like button. It genuinely helps this channel keep making deep dive breakdowns like this one. And if you want to see us cover the next piece of this puzzle, whether that's how to actually evaluate gold IRAs, what's really happening with the Federal Reserve's next move, or how silver fits into all of this, subscribe so you don't miss it. Let me know in the comments. Do you think gold is still worth watching from here, or do you think this run has already gone too far? I read every comment, and I want to hear your take. Thanks for watching. I'll see you in the next one.